Welcome to the Rare Liquid podcast. Today, I'm speaking with Hari, who went to Wharton for his undergrad and also for his MBA. And so he's a fellow classmate of mine. And as a fun fact, he was our graduation speaker as well. And I'll leave a link to his speech in this episode's description. Now, before his MBA, Hari worked at JP Morgan in investment banking. So a fellow JPM alumnus just like myself. He then worked at the Megafund cd&R in private equity, and then worked at Blue Haven Initiative in venture capital for 2 years. And so in this interview, we touch upon banking a little bit, but primarily focus on Hari's experience in private equity and venture capital. And there aren't a ton of people on this earth really who have experience in both of these buy-side industries. So Hari provides a lot of just really good advice and unique insight into what life is like on the buy side. And so I hope you enjoyed this episode. Now, before getting started, if you're interested in breaking into private equity, you're definitely going to want to check out the Private Equity Investing Certificate Program being offered by Wharton and Wall Street Prep. This program is sponsored by top firms like Blackstone, Carlyle, and KKR. And over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real estate PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and be sure to use my code RARELIQUID to get $300 off and sign up by the early registration deadline to get an additional $200 off. And I'll leave a link to all of this in this episode's description. All right, Hari, thank you so much for making time today. Do you mind first just giving us an overview of your background?
Yeah, for sure. First of all, thanks for having me, Ben. I'm excited to be here. My background, I guess starting at the beginning, I moved to the US when I was 1. I was born in India. My parents immigrated here and grew up most of my life in North Carolina, and post high school, went to undergrad here at Penn at Wharton, graduated in 2016 with a BS in economics and concentrations in finance, entrepreneurship, and social impact and responsibility. And I think the short story of my undergrad was that I explored a lot of different things within the business realm. Those concentrations I mentioned were pretty aligned to where my interests were. And over time, realized that longer term, I wanted to do something in the impact space, but shorter term, wanted to build a really solid foundation of skills. Knew I had an interest in finance, which I'm sure we'll talk about later. And so right after undergrad, ended up going into investment banking, worked a couple years at JP Morgan in the financial institutions group in New York. And then post JPM, moved to private equity at a Megafund, Clayton, DeBillier and Rice, also in New York. Was a generalist there, focused on a variety of verticals. And then post cd&R, actually moved to impact investing, kind of tying back to what I mentioned earlier, and moved to a family office called Blue Haven Initiative. It's a family office focused entirely on impact investing. And I helped lead the ventures team focused on seed and Series A investing, mostly in emerging markets.
Awesome. And I think we'll be able to go into a lot of questions about private equity versus venture capital. I'm super excited to hear what all your insights are, because a lot of people really usually want to break into one of those two industries when they're thinking about the buy side. Before that, though, I wanted to ask a little bit about what got you interested in business in the first place. Like when you came into undergrad, you said you explored a lot. So what were you exploring, and what got you interested in business in the first place?
Yeah, I think growing up, I didn't have a great sense of what I wanted to be when I grew up. And business to me represented a really interesting intersection of social sciences, math, and thinking about just the macro picture. And so while I was in high school, I realized that my strong suits were in those things like math and social sciences. And when I talked to a lot of my mentors and friends who were in college at the time, it just felt like business was an area where I could take that knowledge and that degree into a variety of fields. So to me, that optionality that studying business provided would give me a really good, tangible view on the world, and I could take my career in a variety of ways. So that was my initial interest, and even tracing that back further, a lot of that was rooted in my parents moving here when I was very young. Our family back in India, came from a pretty low income agrarian sort of background, and what that meant was there's a lot of on the ground business that was required for them to sustain their livelihoods, and I think I internalized a lot of those lessons, even though I didn't realize it at the time, and felt like that power of business to transform lives and actually have a big impact on society meant a lot to me.
Yeah, that makes sense. And what got you interested in finance then?
Yeah, finance to me represented a really good training ground, and a very hard skill set that would, again, allow me to build a good foundation for whatever I want to do. I think my initial interest in finance came from being here for undergrad. There were just a lot of opportunities to be exposed to finance across real estate, investment banking, private equity, venture capital. And I was fortunate to have that exposure early on in college, which allowed me to then think more critically about what area of finance I wanted to go into. And again, talking to a lot of mentors, friends who had gone down that path, I realized that regardless of what I want to do long term, it was a good way to build skills and to get that experience that I thought was required to kind of move on to the next step in my career.
Got it. And at Penn, I know the competition can be fierce for recruiting.
Sure.
And so did you find that when you were recruiting, did it feel like a huge competition amongst people, or were like people helping each other out a lot? What was it like recruiting for banking at Penn?
Yeah, it's a really interesting question. And I think it's definitely a reputation, I feel like externally, people see of Penn and of Wharton. My personal experience was that this was a very collaborative environment. And again, that's my personal experience. I can't speak for everyone. But when I went through recruiting, I had a lot of my peers, a lot of my professors, a lot of the career services department pitching in to help me in my journey. And so I felt very fortunate because it was everyone else helping to kind of push me along my career path. So what that meant tangibly was when I was preparing for interviews and studying technicals and looking at models that I had no idea how to do, there were people who had done those things that were there to give me advice and offer support, which I thought was kind of critical in my development. So to answer your question in kind of one sentence, it was for me a very collaborative experience.
Okay, yeah, good to hear, because I actually work with some undergrad Penn interns for Rare Liquid, and then sometimes some of them recruiting for banking said that the experience was very collaborative. Others say that it could get a little intense. So I think there's it really depends on who you surround yourself with, and if you're maybe run into one or two bad apples or something. But
100%.
I think for the most part, I also hear similar thing to what you say. And I also wanted to ask about what the difference felt like when you interned, because you interned at JPM and then you went full time. Can you kind of help explain what the difference is like in an investment bank in summer internship versus maybe when you first hit the desk and it's your first 3 months in? How would you compare those months?
The way I would think about it is the internship is really the appetizer to the main course that is your full-time experience. And what I mean by that is, naturally in the 8 to 10 weeks that you're there, you're not going to get the entire picture, but you are going to get a little bit of a taste of what's to come. So my summer experience was in some ways very similar to what I did full-time, but in other ways very different. So the ways that it was similar was, there was a lot of focus on kind of team building, group culture, understanding the dynamics of the people that you were going to be working with. Over the summer, they really tried to plug you into deals that were active and give you a little bit of a taste of what you could expect when you're on the desk full time. And there's a lot of kind of a aspect of, what are you going to be doing all the time when you're coming back full time? When I got there for full time, I think I built on everything that I experienced over the summer, but it was 10x of what I experienced over the summer, right? So I was, fully involved in all of my deals. I was leading, as an analyst, I was leading the modeling for, any given deal. I was working on an IPO, so understanding the equity market side of things. I was working on debt deals, so understanding the debt capital market side of things. So I got the kind of the full spectrum of investment banking as a full-time analyst, which again, I had pieces of during the summer, but I'm not going to get the full picture until I'm there for the full 2 years.
Yeah, they really throw you into the fire in banking a lot of times. And then, yeah, I remember actually, I kind of ramped up generally a little bit, I think slowly, I would say in retrospect, compared to like what I was doing like after my first 6 months. But I do remember like at certain points having all this work for the client and sending it to like just the C-suite and thinking like, I can't believe that what I did is like going to them like fresh out of college. But I also wanted to just broadly ask, how was your experience in banking? Did you enjoy it? Did you hate your life? Like, what was your takeaway? And especially now looking back and you have this like full picture of the experience. How was banking for you?
Yeah, I think my candid response is that it was a great learning experience. It was by no stretch of imagination a fun experience. And I don't think you're ever going to meet someone who went through investment banking who will tell you that it's a very easy, relaxing job. And it comes with its trade-offs, right? I worked very hard. I had very long hours. But at the same time, I think I took away quite a bit in terms of technical skills, in terms of work ethic, and in terms of building a really strong network. I mean, a lot of the people that I worked with in investment banking, I'm still very, very close friends with. And you build some lifelong bonds with those analysts and associates that you're in the bullpen with many hours of the day. And those are some of my best friends. So what I take away from investment banking, are the skills, the network, and just the experience and work ethic that you kind of build throughout.
Yeah, I personally, having worked at the same firm, but in different groups and different offices, I'm sure we had different experiences. But what I usually tell people myself is that if I could go back in time, I would probably still be okay with, and for the most part, want me to have gone through banking because I took away so much from it. Yeah, but at the time, there are a lot of tough moments throughout the job, as you mentioned.
Absolutely.
And I wanted to ask, what made you want to switch from banking to PE? Like, did you already kind of know going into banking, like, I want to go on cycle recruiting and I want to recruit for private equity, or were you off cycle? Like, can you walk us through that transition?
Yeah, I was on cycle, but I will caveat that response by saying I like to think I've been pretty deliberate in my career choices throughout, even going into investment banking out of college. I really thought about that choice and thought about what I was going to be signing myself up for. And when it came time for private equity recruiting, I know you've talked about this a lot on your podcast. There's a sense of on-cycle recruiting where it happens really quickly, and a lot of people just kind of get sucked into it. And I knew coming into banking that I didn't want to be sucked into that process. I wanted to make a deliberate choice to actually go through that process. So when it came time for it, so my process kicked off in, I think, January. And I know these days it's even earlier than that.
Those were the good old days, I guess.
Yeah, exactly. When you had a little bit more time. But this was January the first year. So
yeah, still again, not even that much time.
You've only been on the desk for 5-6 months.
Yeah.
But I think a few months into my career in investment banking, I thought about the next step, where I want to go with these skills that I was building. I was having a good experience, like I said, from the learning perspective in investment banking. But I also knew that longer term, I wanted to be a little bit more close to the ground in terms of interacting with the companies. And I wanted to be on more of the, quote unquote, decision-making side. And I thought that private equity presented a really good opportunity for that. But I also knew that the experience that I wanted to get out of private equity, I didn't want that to be similar to what I was doing in investment banking. And I think there are a lot of private equity experiences out there that are very similar, particularly when you build a lot of scale. You get, I think, attached to a lot of the processes and just the kind of the nitty gritty that happens in investment banking. So all that to say, when I was going through the private equity recruiting cycle, I made a very targeted list about what types of places that I wanted to be. And that meant I wanted to focus on firms that at least had a strong operational component. And I know a lot of private equity shops talk about operations, but I think you can distinguish the firms that truly commit to that rather than purely focusing on the financial side. And I also want to be at somewhat of a kind of a smaller shop as far as the number of people that were working on deals, just so I would have more direct involvement with those companies and more direct involvement with the deals that I wanted to be working on. So that's how I approached the private equity recruiting process. That meant that I self-selected out of a lot of the recruiting for perhaps some of the largest of the large private equity firms. And I had a targeted list, which I'm sure we can talk about in a bit.
Yeah, I think it would be helpful if, since you had done so much research about your targeted list, and also you have a fuller, a good understanding of the private equity landscape now. Which firms are the ones that have this, in your opinion, stronger operational side versus like the ones that are super, super large and are kind of mired by a lot of processes because they've grown so big?
Yeah, I mean, this answer for me will perhaps be a bit dated because this is based on the kind of the target list I had back then. But cd&R was at the top of my list, and I don't say that because I went on to work there, but it truly was number one for me for a variety of reasons. And a lot of that just had to do with the operational model. They have a really strong team of operating partners plus operating advisors who are essentially former CEOs of large corporations who then advise the financial folks on the deals that we're working on and then get involved directly with the portfolio companies afterwards. So that type of model was a big consideration for me. And as I went through the list, a lot of different names popped up, both in pure private equity, but also in kind of the growth equity stage. And so just to, this isn't a comprehensive list, but a few off the top of my head, General Atlantic, I thought had a good focus on building value with companies. TA Associates, I thought similarly had more of a model of working directly with companies. Warburg Pincus, I thought also had a strong model there. And I think those types of firms, again, the list goes on, but in my mind, the firms that had a strong structure around that and didn't just market the operating, but also put that into practice, those were the types of firms that I was trying to target.
Got it. Yeah, I actually took the advanced topics in PE class with the professor who worked at Warburg.
Yeah.
And he's kind of talked about the operational stuff. Or the operational side of Warburg. So it's good that you're verifying it, that he wasn't just, saying stuff that wasn't true, I guess. But I wanted to, before I have a lot of questions about cd&R, I want to learn more about the firm. But before that, I wanted to kind of ask about your recruiting process for PE. Did you use any resources in particular that were really helpful? Or was it more of just practicing LBOs, maybe looking at LBOs that already existed in the JPM folders somewhere? Like, how did you prepare for recruiting?
This is another area where I feel like I've been very fortunate to have the friends and the network that I have. As you alluded to, a lot of it just comes from institutional knowledge, and not just at JPM, but having friends who work in private equity or work at similar banks who have access to practice LBO models, practice interview questions, who've just built up a repository over time of what you could theoretically expect going into an interview. And typically, and I know this is a topic you've covered in some other podcasts as well, typically the interview process involves kind of the modeling test, which tests your technical skills, and that's table stakes for most private equity firms. And then there's a series of both technical and behavioral questions. Once you get past that modeling test, a lot of it just has to do with aligning yourself with the culture of the firm. And many of the questions that they ask just have to do with, are you someone who's genuinely interested in this firm? Have you done the research here? Do you know what our model is? And do you know how we differ from some of the other shops that you're recruiting for out there? So for me, that prep involved practicing LBO models, practicing behaviorals, and doing a lot of research on that target list that I mentioned earlier. I don't think I'm the type of person who overly prepped for these interviews. I'm sure looking back, there's a lot more I could have done. But I think there's a balance between, going all out and spending every waking hour practicing LBOs and being comfortable in kind of who you are and what type of target firm you're looking for. And that also speaks to kind of narrowing your list down. I think if you recruit for every single private equity shop out there with no focus, it's going to be a bit of a tiring interview process.
Yeah. And you're working in banking, so you don't have a lot of time anyway.
Exactly.
Do you remember if any behavioral technical questions you were asked kind of tripped you up though? Or you're like, oh, that's like an interesting one or it was a challenging one? I know it was a while back, so no worries if not.
Yeah, less so trip me up and more things that maybe I wasn't entirely expecting. So a good tangible example is in a couple of interviews I had, they asked more consulting type case questions, which going into the interview process, I knew that I'd have, that technical side of things, the behavioral side of things, but I didn't necessarily anticipate that there would be, a case like, hey, let's say we have a company that we're looking at that sells, XYZ widgets. How do you estimate the market size? How do you think about the pricing here? How do you think about the revenue potential? Those types of questions, which are more common in consulting case interviews, also show how someone thinks and how they approach problems in an analytic way. And I think a lot of private equity firms use that to try to get a good proxy for how you're going to handle ambiguity. So not necessarily an area that I was, fully tripped up on or I couldn't answer, but definitely somewhere that I had to adapt as I went through the interview process.
Yeah. I mean, actually, I feel like that was a somewhat of a surprise for me. But in the banking recruiting process, I was asked how many times the ball crosses the Wimbledon net and it was market sizing question, basically. Yeah. Luckily, I had prepared for consulting recruiting before. So it was, I think, like a plus for me.
Right.
And then also I recruited for one PE shop firm, like off cycle in my second year when I was exploring things. And they also asked me a case. So yeah, I guess that is on the table. It's something you kind of want to look into a little bit if you have the time. And I also wanted to ask about cd&R's recruiting process. I mean, were they, if you're able to share, were they one of the firms that give the cases? Or basically, if someone listening to this was recruiting for cd&R, what kind of recruiting process should they kind of expect? And I know things might have changed.
Yeah. And again, with that caveat that things might have changed, I would say it was a pretty standard interview process within the PE on-cycle recruiting world, at least, as far as, having a modeling test, having a few behavioral interviews, having that type of case study that I just mentioned. And, the kind of the final rounds are really about sense checking how you match up with the culture at cd&R and whether or not, you kind of align with the values and the investing style that cd&R has. And so while it was pretty standard, I think towards the end, it becomes very specialized in terms of the types of questions that they're asking and what information they're trying to probe for. But again, the actual question that you get asked is probably going to be pretty standard, versus the other PE interviews.
Okay. So then let's kind of dive into cd&R, how they kind of differentiate themselves. You kind of talked about they focus a lot on operations, but I'm sure there's a lot more. So could you help walk us through how cd&R tries to really differentiate itself from other PE shops?
cd&R's philosophy is really rooted in building long-term value for its businesses. And I know that's it's a fun tagline to say, but what that actually means is when they look at investments, they're trying to find differentiated assets. They're not trying to participate in a lot of auction processes where, there are 50 different PE bidders coming in and whoever pays the highest price wins the bid. It's more about trying to find value in underappreciated assets, distressed situations. A lot of the investments that they've made are with family-owned businesses that are now trying to, go outside of the family ownership. And so they try to build this partnership approach with every company that they invest in. And they have a fairly patient capital approach as far as a hold period. So they're not trying to kind of invest and flip immediately off the bat. And a lot of that has to do with the operational component that I mentioned earlier. there's a strong thesis, I believe, at cd&R that by bringing in people who have experience and who have done this type of playbook before at multinational corporations, you can create value regardless of kind of the specific company. And so they really try to match the operating partners and advisors with the right companies and try to bring in those inherent networks that these people have into those companies and try to improve margins, try to improve productivity at the company, and focus on, like I said, that long-term value rather than just cutting costs and piling on a bunch of debt and getting returns that way.
So very interesting, because a lot of PE shop firms are known for, as you kind of alluded to, buying a firm, levering it up, improving operations, selling it to maybe another PE shop or to a strategic acquirer. And this long-term patient capital, like, did you ever see a potential conflict of, like, let's say a deal is happening and it would be advantageous for the firm to be sold soon or within a short period of time because markets look good, it'd be a good IRR, situation's right. And did you see, like, I don't know, partners making the tough decision, like, not to sell because operationally, like, I don't know, for some reason, maybe better for the company not to, or anything like that? Like, was there ever any conflict, or did you feel like cd&R was very good at just staying true to that investment philosophy and holding for, I guess, longer periods of time? I guess this also asks like a shorter, briefer question of what were the holding periods like? Was it longer than the typical 5 years or so?
I would say to answer the last part of that question, the holding periods were, I'd say, fairly similar to overall PE, probably 5 to 7 years on average, some shorter, some longer. But the key focus on kind of that conflict question that you asked was really about staying true to the model. So if there was an opportunity to sell earlier and market conditions were great and the company had been built up over the course of a few years, sure, like cd&R would probably sell that asset, at least in my experience. But at the same time, if there was an indication of interest from some buyer and it was just way early in the hold period and cd&R believed that there was still a lot of value to build and more kind of operational stability to be had within the business, then I think it's a natural choice to stick with that business and think about selling kind of later on in the future. So what I was really impressed by while I was at cd&R was just everyone's diligence and focus to that model. And people had that steadfast belief that if you kind of followed this mantra of building that long-term value with your operating capabilities, you would realize success later on in the future. And I think that's generally proven out. The funds in the past have had great financial success. And I know recently cd&R raised a pretty huge fund for their newest iteration. And so clearly the market values that type of approach as well.
And so when cd&R, you kind of mentioned they were looking for more kind of like special situations, distressed companies, family-owned businesses, then did you find that cd&R was a lot of times like the one of a few bidders or an only bidder because not a lot of people have like found this asset? Or were they in very small, like were they in processes where there are not a lot of bidders? Or was it also, cd&R is a large firm now, so was it kind of across the spectrum? Like they'd be in some processes where there were a lot of bidders?
At least when I was there, that was the goal, to be in a small pool of bidders. And I honestly worked on quite a few deals where we were kind of the only presence at the table. And that was largely due to just relationships within the firm. So both from the operating advisor side, but also from the financial partner side, cd&R has a very long history in the PE world, and they've built these durable relationships across companies over time. So whenever there was a corporate spinoff, or as we talked about, a family-owned business that was coming onto the market, it was a unique position where cd&R could be the first call in those situations, which then allowed them to structure a deal that was somewhat off market. So the the business wasn't necessarily going through a investment banking led auction process, and instead was kind of as you talked about, like a special situation where, cd&R had the right to just work with that company directly and figure out a deal.
Yeah.
Not to say that there weren't auction processes. I was definitely involved in a few of those. And I'm sure as the firm has gotten bigger, there's probably more of that with more capital to deploy. But I think traditionally and during the time I was there was a big focus on winning through having that unique capability and unique advantage.
Yeah. And as we talked about before this conversation, I actually worked on a deal when I was at JPM with cd&R. And I do remember there weren't a lot of, it was also a corporate spinoff. It was a spinoff that was a dual track of like M&A and also potentially looking into an IPOing separately. And they ended up IPOing, but it was a very small number of buyers. I remember like the number of PE shops that were in that process. I remember my MD like kind of helping the client select which ones, and then we ended up choosing cd&R and like a few others, and rather than like having this really big pool. But I also want to, and so my experience working with cd&R is like extremely thorough. Like that was just like the impression we got. I remember also, because I barely knew anything about PE at the time, but I just remember my associate or VP just being like, "Oh yeah, these PE guys, they're very sharp," or like something like that. And then I wanted to ask about the investment criteria that you guys kind of had when it came to investments. I know it's not as simple as like, here is a list of checkboxes and, as long as the company fits these, like, then we're good. It's like always catered to each investment because companies are so wildly different. But could you give us a general sense of the investment criteria for cd&R?
You put it well in that there's no one size fits all. If I had to say a general framework, I think cd&R focuses on, the financial aspects. So the general things you would expect, right? Like what's the revenue profile look like? What do margins look like? Are these cash flows stable? And is there room for improvement under cd&R ownership that can create more value, kind of tying back to the operating aspects that we talked about? That's one aspect. One is company specific. So what is the structure of the organization? What does the management team look like? Do they have the right capabilities in place? Do they have the right processes? And is the organization optimized? If not, again, is there a room for cd&R to plug in and with their capabilities, can they improve the overall organization? And then third broad bucket, I'd say, is just market and macro. So if you think about where the company is in the broader market, in the competitive landscape, how do they stack up against other pure play competitors? What are the macro headwinds or tailwinds that are impacting this organization? And then if we had to plot this out in the next 5-10 years, what is, cyclicality in the market look like when you apply it to this business? So that's the broad framework. Obviously, as you said, there's a lot of nuance depending on the specific investment. And I want to go back to a point you kind of raised about, diligence being very thorough and data driven. I think that's probably true for a lot of private equity organizations. But speaking from personal experience at cd&R, we had a very heavy focus on being data driven and analyzing as much data as possible to make an informed decision. And so what that meant was a lot of our analysis had to do with, going into those data rooms and pulling all these files and cutting it a bunch of different ways to say, okay, within this one segment within the business, how does the trajectory that we've seen over the past 2 or 3 years play out again in the next 5 to 10 years? And really trying to take that micro level analysis and, expanding it to the macro side of things. So that type of diligence process led to what I believe are more informed decisions about how to make the investment and how to tie it to that broad framework that I talked about earlier.
Hey guys, hope you're enjoying this episode so far. And if you're interested in breaking into private equity, you're probably going to have to first break into investment banking just like Hari did. And on that note, I've been working super hard on a how to get into investment banking course, with my classmates who will be working at Goldman Sachs, Evercore, and JP Morgan M&A. If this is of interest to you, I'm aiming to release the course in the early winter of 2024 this year. And be sure to also go to the link in this episode's description and sign up now in order to get a 50% early bird discount. And I do want to ask about the operational side a little bit more as you've been talking about it. So let's say that you start a process, you find a target, you do all this diligence for it, and then you take it to investment committee, it passes, you guys make an investment. Starting from that point onwards, when you're bringing all this operational expertise to the company, what does that look like in, I guess, like a little bit more detail? Like, do you bring in these advisors to the company? And a lot of times I know you may need to like replace certain key members of the team for the portfolio company. Can you provide us more detail as to like post-investment? What does the operational side look like?
Typically, the post-investment support relies on both the financial team and the operating team. So from the financial perspective, as soon as the transaction is signed and you move towards closing, there'll probably be, one or two people from the team that are on the board for the company, given that, typically cd&R will take like a majority stake in the business. They'll have rights to a certain amount of board seats on the board in addition to the management team. So that'll be one aspect of kind of the governance side of things and the structuring side of things. On the operating side, as I mentioned earlier, there's the component of operating partners and advisors that work on the deal with the financial team. So when we're actually going through the deal process, these operating partners are actually helping with diligence, and they're providing a very unique lens. So we have the financial lens, right? We have the LBO model, and we say, based on all of the numbers here, here's what we predict. But having an operating partner or advisor on top of that adds an additional layer of nuance to say, yeah, those numbers make sense on the page, but here's what they mean in reality, right? If we project that margins are going to expand by X%, here's what that actually looks like. Here's a process that we need to implement. Here are the suppliers that we might need to contact. Here's the competitive dynamic that we need to consider. And so they'll be fully involved in that whole process and advising during that entire time. What that then means is once the investment is actually closed, they'll then join the company either as another board member or potentially as a member of the management team for a little bit and help them with all those processes. And over time, cd&R specifically has also developed capabilities in different functional areas. So they've brought on people who are experts in supply chain, people who are experts in manufacturing process to add that additional layer of if a industrial company needs to optimize its supply chain and distribution network, cd&R then has those capabilities in-house to be able to do that.
I guess I should have asked earlier then, when you go into cd&R post-banking, are you a generalist or are you aligned to an industry?
So that model has also changed over time. When I was an associate, I was a generalist. So I worked across, at the time we had 4 verticals, industrials, tech/services, consumer, and healthcare. And I was fortunate because I got to actually work across all 4 during my time there. These days, I believe the model is associates are specialized. So when they come out of banking or whatever background they're coming out of, they are placed into a vertical. They obviously have a say in that, but they're aligned to a specific vertical coming out of their pre-PE career.
Got it. And do you feel like cd&R, they're best known for any of these verticals? Like, are they really, really strong? Like every bank, most PE shops, I would assume, are like the best at in certain groups or verticals. Do you feel like cd&R has a specialty at all, or are they pretty strong in all 4 of these?
I would say, honestly, I think they're pretty strong in all 4. And the reason I say that is because it's not the type of private equity firm, in my opinion, where, like I said before, they're competing in every auction for every big business that's out there. They try to find that specialized scenario in each of those verticals. And so they've developed really strong capabilities in each of those verticals. So, if it's in healthcare, they've developed a really strong reputation for being good at corporate spinoffs and being involved in kind of Medicare Advantage businesses and having a strong thesis in that. In technology, they've done a great job in IT services and building out a new software arm. In industrials, they've done a great job in distribution and manufacturing types of businesses. And then consumer, they've made some great investments across, beauty, across manufacturing slash food services types of businesses. And they've recently expanded kind of a more focus on consumer services and consumer goods. So I'd say overall, in my view, I think they're strong across all four.
Okay, got it. And when it comes to these potential targets and investments, is it at all the associate's job to do some of the sourcing, or is a lot of it driven by the partners finding deals?
More of the latter, I would say. The associates have a role in it, but what I actually liked about my experience at cd&R was it definitely wasn't kind of a cold call type of firm where the associates were required to be on the phone all day and find new opportunities. Like I said before, cd&R has had a very strong reputation in the market, and with that comes a strong network, proprietary deal flow, knowledge into where and when new deals may pop up. And what that means is the associates can then focus on what I consider to be some of the more interesting parts of the job, which are, working on deals themselves, working with portfolio companies, and understanding kind of the broader market dynamics that are at play.
And then what about the culture? Once you were at the firm, like this was a firm that was at the top of your list, you leave banking and now you're on the investing side at the desk, right? How did you feel? What were you like soaking in the first like 6 months? And then later on, as you look back at the few years that you worked there, like how would you describe the broader culture?
First 6 months were drinking from a fire hose. Honestly, kind of similar to banking in many ways where you just get thrown into the mix. But I think having had the banking experience, I came in with a good foundation. The culture overall, I would say, ties back to a lot of things we've talked about. Very data driven, people who are steeped in the numbers and make informed decisions based off of that. People who take the job seriously, but don't necessarily take themselves seriously, which I think is a really good characteristic because it ties to just having humility, knowing that, you have all the numbers and you have all the data, but decisions can still go wrong. And having that humility-based approach to investing, I think, is very important and very unique. And the final thing is, generally, I think people are just really good human beings and exhibit kindness outside of kind of that pure work dynamic, which I think is actually critical when you're working long hours, when you're working really hard on a deal. People do care about your livelihood and care about who you are as a person. So, I know there's across banking and PE, there are a lot of horror stories of places where you just feel like you're a cog in the machine. And I didn't necessarily have that experience while I was at cd&R.
Yeah, and as I hear about your description of cd&R in general throughout this conversation, I feel like that last part also aligns with the long-term view that you kind of mentioned earlier on about cd&R as well. And on the note of horror stories, I had one of our classmates worked at like a middle market energy PE shop for the summer. And then he said that for his internship, the culture was like you go in and no one talks to each other. I was like pretty surprised to hear like something like those kind of cultures even exist. But yeah, that like he ended up not even taking the return because he didn't have a positive experience. So and I also, having worked with cd&R on that one deal, you guys seem just very like methodical, but I didn't really know what you guys were like. And so I think hearing about this culture is very enlightening in certain ways. And I also wanted to ask about the hours. So what were the hours like when you were working in PE?
The hours, generally put, still intense. I think when you're managing that much capital and you're working on important deals, you're naturally going to be working quite a bit. I don't know if I have a specific figure, but I would probably, put it on the range of you're coming in at, 9 a.m. and you're working well into the night. If you're, not on an active deal, I think there's definitely a lot more balance. And in general, people tried to protect weekends as much as possible. But if you are on an active deal, you're kind of, you're on the clock, especially when it gets close to the final stages of the deal. You're probably in the office, well after midnight, and you're in the office early again the next morning, and you're working on that until you push it across the finish line. When I was there, we had an associate class of 7 people, and so there was a lot of work spread across a pretty small pool of associates.
Yeah, that's pretty small. Yeah.
These days, I think the associate classes are much larger at cd&R. So this is, again, probably a slightly dated view on what the firm specifically is like. But in general, I would say fairly intense hours, but it was correlated to just the amount of work and the types of deals that we were working on.
Got it. And is cd&R only, I would assume they have multiple offices. Was that, correct me if I'm wrong though, but were the 7 associates spread across all offices or just New York?
So we had 2 offices. We had New York and London. I don't remember how many people were in London, but the 7 was specific to New York. But there was a separate team in London focused on European investing. But we didn't have much, cross collaboration as far as deal work. We were close to them from a cultural perspective, but we didn't necessarily cross on deals. So the work that we had in New York was specifically for the New York team.
Got it. And were you guys focused mainly on deals in the US?
That's right. Yep.
Okay. So no international type of deals or whatever.
Pretty much solely in the US. Some of the businesses that we looked at or invested in would have operations across the globe. And in those cases, we'd maybe have some trips to due diligence in various parts of the world. But for the most part, it was almost entirely US focused at the time.
Okay. And then when it comes to working in private equity, can you also help walk us through the different titles, I guess, and roles, and how your responsibilities change as you go from associate to partner? And it can be kind of like general. I know there's a lot that goes into each one, but if you had to kind of summarize it, what would those different responsibilities look like?
Yeah, absolutely. That's a great question. I'll talk from my experience at cd&R, recognizing that the titles that we use at cd&R are not necessarily the same across the industry. So when I was there, at least, we had essentially 3 levels. So we had associate, principal, and partner. Associates were straight out of, at the time, usually banking. They were, typically there for 2 to 3 years and could either go get their MBA, could stay on, could explore lateral opportunities. The associate role mostly focused on leading a lot of the technical work on deals, leading a lot of the analysis, and working on kind of reporting and portfolio management in terms of the kind of the details and the presentation. So, you can think of the associate as kind of the first layer on any transaction or any portfolio thing. Principals, they are the bridge between associates and partners. Principals could be post MBA. They could have been there for a few years. At the time, at least, there's no real stratification. So there was no like junior and senior principal. It was all just called principal. And they were the ones who were really quarterbacking the deals. So when, you had a diligence process, they would think about how do we target a diligence agenda to get the information that we need. When we had to make investment committee decks, they would kind of be the first person to look at how to structure the deck and how to create the thesis and create the story to present to our investment committee. And they were the ones from a portfolio perspective who were usually directly interfacing with some of the senior management and working with them on a day-to-day basis. And then finally, the partners, these are people who, at least at cd&R, have typically grown up at the firm, have been there for a while. And these are people who kind of do everything, right? They're leading deals at the highest levels. They're going out there, looking at new market opportunities. They're crafting theses for different industries. And then they're directly involved in kind of the board level of portfolio companies. And, they're kind of the first call for the CEOs of those companies. So those were the three broad levels. I will, last thing I'll add on that is that I know across the industry, there are some places that have analysts. So people that come straight out of college, you can think of those as similar to the associate role, but maybe less on kind of the higher level design of things and the actual structuring of things, and more on the technical aspects. I know some places have senior associates who kind of play in between associate and principal. And I know some places have VPs, vice presidents, who are perhaps just under the principal level, but just above the senior associate level.
Thanks for, that's a very good, thorough overview. And I wanted to also ask, when you were at cd&R, given that from what I've heard, a lot of PE partners, they're getting good carry, making good comp. And as you grow more and more senior, it's harder to leave because you are economically, you're just earning so much more and there's only so many spots. So did you feel like, let's say cd&R in general had a good culture of, I see a path towards staying at the firm for a long time? Or did you feel like did most people feel like, oh, there's not enough space for me if I stay at this firm long term? Like, what was your view on that?
It's interesting because at the time, given that we had a smaller class, we had 7 associates in my class, there was quite a bit of self-selection that happened. So I knew as I was going through the experience, again, probably something we'll talk about later, I knew that I wanted to kind of pivot and explore the social impact side of things. And so I knew that, while I liked the experience at cd&R, I didn't necessarily see myself as being there super long-term. So I kind of self-selected out. And I think similarly, other people who went on to do different things also self-selected their own paths. I think if you were someone who was actually interested in staying on at the firm, it ended up being that there were a couple of people that would actually be interested. And I think there was a path. cd&R always stressed the importance of kind of having that homegrown culture and people who really understood that thesis, because it is, as we talked about, it's a fairly unique perspective to only deal with, unique situations, non-auction processes, build real long-term value. And they tried to find people who were associates, who could be principals, who could then be partners.
Gotcha.
So I think to your question, I don't think there was necessarily like a block that prevented people from rising up. If you were someone who was actually really interested, then there was the opportunity to stay on. And I have a few friends who I worked with or who were in the class below me, who are either still at cd&R or going back to cd&R post MBA.
And on a more reflective note, when you think about your time at the firm, were there any key personal and or professional lessons that really kind of stuck with you?
Yeah, I'll maybe give 2. It's a really interesting question. On the personal side of things, I think the biggest thing that I learned was to ask why and understand the underlying meaning behind the work that I was doing. Particularly in banking, coming out of banking, you have a sense that you're trying to get things done, right? You have tight deadlines. You have a lot to get done. You don't have a lot of time to do those things. And so you're just like trying to crank out output. Whereas in PE, you still have those deadlines and you don't have a lot of time, but there's more of a stress on understanding the intellectual reason behind things. So personally, I think it was a big learning opportunity for me to not just do the work because it was handed to me, but also understand why we're doing the work. And that is a critical unlock, I feel like, for developing your career. Because once you can think about the reason why you're doing a certain something, you then unlock this level of understanding about the job to then position yourself to take on elevated roles and responsibility. So personally, that was a big learning for me. Professionally, I think the biggest thing was that, if a lot of people talk about work-life balance, that's obviously a big consideration for many people across many different industries. In something as intense as private equity or generally investing or finance, the onus is kind of on you to craft out that work-life balance. And I know it's tough as an analyst or an associate to really, have that and figure out the right balance. But if you can find a firm and a company with the culture that supports you and treats you like someone who is part of the team, there will be opportunities for you to figure out the right times to, take a vacation, to take the weekend off, to take a little trip, and be offline for a little bit. And I don't mean that's going to be all the time. If you're working on an intense deal, that's just probably not going to be possible. But you do have to really indulge in your hobbies and indulge in the things that bring you happiness outside of work, because otherwise the job will consume you. And so professionally, that was a big reflection for me to figure out what actually mattered to me and prioritize those things when I was able to.
Yeah, and I'm sure hopefully you're able to indulge in a lot of that stuff and your hobbies during MBA, which we'll kind of get to a little bit later. But I wanted to kind of transition now into your transition to venture capital. You touched upon how you wanted to do a little bit more work on the social impact side of things. And so what made you decide to leave at the time that you did? Because you could do PE you could have worked at cd&R for like 1 year, like 5 years, and then moved it. So what made you decide to leave at the moment that you did?
It was actually a natural transition point for me. The traditional cd&R structure was to have a 2-year associate program, after which, as I mentioned before, people would either go on to business school, go on to a lateral opportunity, go find something else to do, or potentially stay on at the firm. And so for me, I was coming up on those 2 years, June of 2020, which, as I'm sure everyone remembers, was in the midst of the pandemic. And I just shifted to working from home. I'd gone back home to North Carolina and I was working from my parents' house. And I think a few different things happened. One was just being at the end of those 2 years. Naturally, I was starting to look for different things. But then two, I do think the impact of the pandemic and just being back with my family and working from home caused me to really think about, what I was doing, where I wanted to take my career, what I wanted to make of this kind of one precious life that we have. And that's where I decided to make that pivot into something that was fairly different from what I had done traditionally. Yes, VC is investing, and yes, it's still in finance, but the VC investing style is very different. I moved to a firm that focused entirely on seed and Series A investments, which is kind of the earliest that you can get. And the impact side of things, I moved to a firm that is entirely focused on finding businesses that are building durable societal value in some way. And while we are focused on returns, we're also equally focused on the impact that those companies are making. So all of that to say, I kind of got to a point where I thought about what really mattered to me. And I figured, look, like I've got 4 years of work experience at that point. I felt like I've built a good foundation of skills. Why didn't I make a bet on myself and try out this new thing that I've always been passionate about, but maybe a little bit scared to go into?
And it's interesting that you talk about this, or when I think about how you were at cd&R, very, very data-driven and analytical, and when you go through a PE process, there's tons of data to kind of look through because these companies tend to be much more mature. And then now you're going to like a Series A or seed where there is information, but a lot of times I would assume you're betting a lot more maybe on the team or the market, and you find data in like other ways, but not necessarily from the company. Like, was that your experience? And if so, did that sharp contrast drive you crazy at all, or was it refreshing? What was your experience like during this transition?
Yeah, I'm smiling at this question because I get asked this often. And what I tell people is it's a very stark contrast going from a data room filled with multi-tab models on anything that you could imagine, right? Like any aspect of the business you could imagine, to all of a sudden getting, if you're lucky, one Excel file with one tab with 10 rows with a very, very basic financial statement. Again, if you're lucky, maybe you get projections, but you usually don't. So that type of environment definitely challenged me in a really good way to take some of that data-driven analytic ability that I built and try to apply it in a different way. So without the benefit of all of the numbers on a page in front of me, I now had to tap into some more of those operational things that I learned in P and in banking around what makes a business succeed. What does thinking about a market at the highest of levels look like? And then how do you even analyze a management team and the entrepreneurs that you're working with? And, I'm not going to sit here and say I had all the answers right off the bat. I'd like to think that over the time that I was at Blue Haven, that I started to build that capability. But it was definitely a tough transition. I do think that having the private equity background and the banking background actually helped me, because the very basic modeling that I'd have to do in VC or even understanding different scenarios actually helped me analyze these things, I think, at a more efficient pace. And I was able to kind of spin out outputs a lot quicker.
And how did you even find this position at Blue Haven? Were headhunters reaching out to you with positions, or were you cold emailing the firms that you were interested in? How did you come across this opportunity, and how'd you go about your VC recruiting process?
This was a very niche recruiting process. I was definitely spoiled coming out of banking, where I had my next job lined up, 6 months into my first job, and it was a very structured process. Here, it was a lot more about networking, doing a bunch of research, building kind of a similar target list, but then also being very opportunistic. So the way I approached it very simply was I started out by looking at the landscape. I knew that impact investing spanned everything from kind of foundation level stuff where you're doing more grant making, all the way up to private equity firms that have impact arms. And what I realized was I wanted to be somewhere on the earlier stage of that, but I also wanted to be doing investing. And so I felt that VC impact investing was probably my sweet spot as far as recruiting. And then as far as Blue Haven specifically, I had heard about the firm quite a bit as I was going through that research process. Blue Haven's been around for a while now, and the firm has developed a really strong reputation in the impact market. And the way I got this role was actually a bit serendipitous, as I think a lot of things in life are, where I had worked with the Wharton Social Impact Initiative as an undergrad, and I reached back out to them and just said, "Hey, I'm recruiting for jobs in the impact space. To the extent that you all have any leads or any open roles that you've heard come across your desk, please do let me know." At the time, they didn't have anything, but a week or two later, they actually reached back out to me and said, "Hey, this partner that we work with, Blue Haven, is looking for someone of kind of your role and your ability. If that's something that's interested, let us know." And I had actually just applied to that role a day or two before, and they were able to then connect me, and I talked to the team, and then I went through the interview process and ended up working out. But again, as with a lot of things in life, it's just you kind of have to be in the right place at the right time and create your own luck if possible.
Right. And I think that is what I hear about a lot of VC recruiting processes. You're doing a lot of networking. It's almost like it's part of what I think the job is also kind of like. You're just like networking with a lot of people and then kind of creating your own opportunities in a sense. And I wanted to also ask about your recruiting, the interviews that you actually went through. Could you walk us through how many rounds there were and what kind of questions were asked? And of course, every VC firm asks different kinds of questions, I would assume. But can you walk us through what yours was like?
Sure. I'll speak about the Blue Haven process, and then I can talk a bit more about some of the other VC firms that I interviewed with, just because I know it's a pretty bespoke space, and there's a lot of variance. At Blue Haven, at least, it was actually fairly similar to the PE process in that the overall outlines were the same. So I first had kind of a screening test where they focused on just, I'd say, 10 questions, a bit technical in nature. You had an Excel file and you had to look at it and determine, where is the error in this Excel, or, what does the revenue growth look like in year 6 within this Excel? So a lot of just, do you have the ability to read a model, read a set of financial statements? but then also deal with potential errors and be have a strong attention to detail within that model. So that was the first part. Second, I think I went through just a standard behavioral interview, kind of what you'd expect. Why are you interested in the company? Why are you interested in the space? Gauging a sense of, have you done your research, and do you know what you're talking about at the highest of levels? After that, there was a case study, and the case study that I had was essentially just one of the investments that they had done in the past, and thinking through creating like an investment memo for that deal, which involved building out a basic financial model, writing up a set of criteria, attractions, considerations, those types of things. And then finally, a couple of rounds of again, interviews and meeting with different members of the team. And similar to PE, figuring out that cultural fit and whether or not, you are fully bought in to the process. So that was my process at Blue Haven. Speaking for VC more generally, I think it does really vary, but a couple of things I'll point out. One, I think there's a big focus on testing your ability to have a point of view and a thesis on different spaces. So particularly if you're interviewing at one of the more institutional VCs, from what I've heard at least, there's, there can be a lot more questions on how do you think about a thesis within the health tech space for the next 5 years? And just coming prepared with a point of view on those things, I think is really important, because a lot of the day-to-day in VC is about meeting with entrepreneurs and essentially formulating your own thesis while you're investing in companies. And then two, coming to interviews with a knowledge base and a network base that you can then leverage in the role. Because again, a lot of VC is about having that ability to connect with people and connect with entrepreneurs. And in many ways, it's a sales role where you're selling why you should invest in the new high-flying startup. And so coming to an interview with that knowledge and that ability, I think, is really important.
Hey guys, if you're interested in getting an MBA just like Hari, then I wanted to let you guys know about a course that I recently announced called Liquid MBA, which is a how to get into MBA course. The course provides access for all aspects of the MBA application process, access to a library of admitted essays, of which there are 10 per school, and super detailed school-specific advice covering things like student life, academics, clubs, resources, leadership opportunities, essays, and even 30 secrets for each MBA program. We have a 24-hour free trial, so you can check out the course for free, and also a no-risk money-back guarantee if you don't get into at least one MBA program. We also provide lifetime access to our Discord community, where you can connect with peers and get additional support from me and my team. Admissions consultants often charge $400 to $700 per hour, which is crazy to me. And so for the price of a 1-hour call with a consultant, you get everything I discussed and a whole lot more. So I really am trying to make Liquid MBA a really good deal for you and a no-brainer. If any of this interests you, be sure to use my code SUMMER25 to get 25% off until August 30th. And I'll leave a link and information about all of this in this episode's description. And when it came to your day-to-day, as you kind of touched upon, did you find yourself like traveling a lot more? Maybe, I don't know, were you like taking on a lot more meetings that were a bit shorter and they filled up your schedule more versus you being, in data rooms and modeling and building memos? What was your day-to-day like in comparison to PE?
It was certainly more of the relationship building, network building, meeting with a lot of entrepreneurs. Because you're right, there's just not as much data. So I'm not spending most of my day doing that analysis and cutting data. When we're working on a deal, yes, I'm doing that with perhaps the limited amount of data that I have access to. But overall, I definitely spent a lot of time just talking with entrepreneurs, taking a lot of pitches. A lot of the job in VC is about screening. And so you might get, 200, 300 pitches over the course of the year, and you essentially have to distill that down to what are the opportunities that kind of fit into our target bucket and what are the opportunities that actually have potential for success and further diligence. And then you it's a funnel approach, right? Where you start with this broad base and then you kind of narrow it down to the deals that you actually invest in. And the one thing that I that I hadn't mentioned before is Blue Haven is emerging markets focused. And so actually most of my portfolio, almost entirely my portfolio was based in sub-Saharan Africa. And so I spent quite a bit of time, you know, on the ground in Nairobi, in Kenya, and working with entrepreneurs there, understanding some of the cultural nuances, investment nuances, working in that type of market. So that was obviously a very stark contrast for me as well, coming from a you know, late stage US focused buyout firm to then working in this type of setting.
Yeah, I mean, those are very, very different lifestyles. Even though, as you said,
Yeah.
even though they're all within finance, I think that is a very, very different experience. And so, were you, as you were going through the first year or so, I don't know, really, really like enjoying it, or did you find a lot of like challenges? Like, were there any delightful surprises, I guess, and then unexpected challenges on the job?
Overall, I loved my time at Blue Haven, and I'm actually going back post MBA. You know, I think it's a great firm. It's a great culture. Worked on a really small team. It was actually just me and another person who were working on the ventures team. So very, very unique. In terms of my experience, it was definitely not without challenges. One of the big things was I started during the pandemic. So I started in August, September 2020. And when you're working fully remote with a new team, especially when that team is just one other person, it can be really, really hard to actually onboard onto that role. And so it was a unique challenge in terms of trying to get up to speed, trying to learn about VC without having the benefit of seeing someone in person and interacting with them. And the additional layer of that is, as we talked about, because VC it's so critical to just have that connection with entrepreneurs and connection with people in the community. It was also very hard for me to, at least initially, ramp myself up on that kind of that network building and that knowledge building within the spaces that we were investing in. Over time, 6-12 months in, I think I definitely ramped up. And once I was able to start making trips to Kenya and to different parts of the US to meet with parts of our team, that definitely eased up. But initially, a lot of the challenges were less so on kind of the technical and VC model side, and more so on just the cultural job onboarding sort of side.
And what do you feel like now that you have experience? Like, what do you feel like makes for a really good PE investor versus like a VC investor?
A lot of similar characteristics, surprisingly, perhaps. I think both require you to be analytical in slightly different ways. So we talked about earlier, analytical in PE is a lot more about making sense of all of the data you have provided. And a lot of times that's more quantitative. In VC, it's still making sense of the data you have provided, but that can be a lot more qualitative. So about the management team, about the entrepreneurs that you're working with, about the market trends that you've been seeing firsthand. I'd say VC requires a bit more of kind of a gut check and somewhat of pattern recognition. Again, similar things in PE, but you just have more quantitative data to work with. And then I think on the PE specific side, a lot of it is just having a proprietary thesis about a certain sector, and then being able to go into that sector and convince a company or convince an investment bank that's selling a company to partner with you as the next step. And I think a lot of that is a sales type of role, which is similar to VC, except instead of going to a company and selling your big operating capabilities, you're actually going to an entrepreneur and you're saying, I'd love to invest in this company. I'd love to be a partner to you. And here are the things that I personally bring to the table, rather than, yes, to an extent, it's the VC firm that you're working with as well, but a lot of it has to do with you as an individual.
Mm.
So, in some ways, it can be a lot more of a individual approach to investing versus in PE, you just have this big deal team that you're kind of involved with all the time.
And what did you find as you had spoken with a lot of entrepreneurs? Were there any qualities that really stuck out when you were sense checking with your gut and you spoke with a team or a group of entrepreneurs or a solopreneur? What were the qualities that really made them stand out?
It's a good question. I would say if I had to point to one thing, it would be vision with humility.
Mm.
So oftentimes we talk about the most successful entrepreneurs in the world as visionaries, and that's certainly true. But I think to be really successful in the long term, aside from a kind of few nuanced cases, I'd say, you also have to have humility to be able to say, okay, I was wrong about this one thing about the business model, or I was wrong about the market, or I was wrong about this hire that I made, and be able to pivot. The most successful startups that I've seen, at least, are the ones that are able to react quickly and not be so rooted in kind of original thesis that that you forget what kind of the big picture is. So the entrepreneurs that I've seen be really successful are those people who, dream big, think big, have those big visions, but at the same time are open to feedback and recognize that things may go wrong, things outside of their control may happen, and if they're able to pivot and make those changes, then they have a better chance of success in the long term.
Mm. And I want to ask about Blue Haven a little bit because it sounds like a very interesting company. A lot of people also are interested in not only venture capital, but also impact investing. And so, what is the kind of investment philosophy for Blue Haven? And from what I have heard about, kind of double bottom lines, it could be very challenging because you have extra criteria that you need to fulfill in order to make an investment. So, social impact investing, I think, is growing as well. So there are like a lot of players kind of popping up. How does Blue Haven basically kind of differentiate itself, and what is its investment philosophy?
Blue Haven at its core is a family office. It's a single family office. The two principals started it when they got married, and they decided to dedicate 100% of their assets to causes that they felt were meaningful. And what that meant was those causes were essentially impact investing types of causes. So they split the family office into kind of a few divisions. We have a civics team that focuses on government initiatives. We have an initiatives team that focuses on grant making. We have an operations team that kind of supports all of this. And then we have the ventures team, which is the team that I help lead. And so the ventures team is essentially the in-house direct investing team. Our investing philosophy is to find tech-enabled businesses that have a strong societal impact that also generate market rate returns. So that's at its core, that's the investment philosophy. And what that actually means is, because we're focused quite a bit on emerging markets, we're trying to find businesses that support the community in some way. We're fairly industry agnostic. So we've invested in health tech, in energy, in fintech, in human capital. We've really invested across the board. But the common theme across those is what I mentioned: tech-enabled businesses that have a strong societal impact that generate market rate returns.
Mm. And how did you not when you were working at Blue Haven? It seems, because it's a family office, much smaller team. When you go back as well, is it going to be just with one person, and how are teams structured generally? And I guess, what is the headcount? It seems like a pretty small team.
Yeah. So the overall family office across those different teams, I think right now is about 12 people, including the principals. And my team itself, when I go back, will be 3 people. That we essentially hired someone in my place when I went to business school. So when I go back, we'll be a total of 3. And the way it's structured is, each team is kind of, there's no hierarchy. It's pretty flat, given that it's a few people. I was working on a team of 2, and while my title was technically senior associate, and the other guy I was working with, his title was managing director. It was very much kind of working collaboratively and working on the same things at the same time, and also working on different things siloed at the same time. So very flat structure, very small team. When I go back, I'll kind of be in a slightly more elevated position, and take on more responsibilities, hopefully kind of build out my own niche within ventures, and start kind of leading my own things within that vertical.
And mm, given that you kind of talked about responsibilities, I think it'd also be very helpful if you could walk us through what a day in the life looked like for you. I know it changes so much. You're also like traveling to Africa. It's like for some of your weeks. And so, but I guess generally, if you were to kind of describe what a day in the life of a VC investor looked like for you, how would you describe that?
You're completely right. There's no single day. I'll try to generalize. I typically start my day fairly early. And the reason I do is when I wasn't working in Africa, I'd typically be on the East Coast and I'd have quite a few meetings with people who are in sub-Saharan Africa. And given the time difference there, typically I'd have to have my meetings anywhere from kind of 7 a.m. to 10 a.m. In order to kind of fit all those people in. So I try to wake up on the earlier side, do those meetings, usually start out the day with introductory meetings to new entrepreneurs, maybe hear a 15 to 30 minute pitch from people, and then potentially connect with some of my portfolio companies, check in to see how they're doing. If there's a board meeting or something, sit in on those. The late morning, early afternoon, if we were working on a deal, I'd typically try to just do a little bit more diligence on it. If we were in the active stage, I'd be working on the investment memo, craft that. Early to late afternoon, I'd check in with the other guy I was working with. We'd have a chat, maybe an hour, hour and a half, just talk about everything that was going on, put out any fires that we needed to. And then kind of early evening, try to wrap up, do some more reporting. I'd also try to kind of lay the foundation for whatever I was doing over the next few weeks. So if I was trying to attend a conference or meet with other firms who we could co-invest with, I tried to like start scheduling those meetings. So some logistics time at the end.
Got it. And were there any parts of the job that you enjoyed the most versus kind of like the least?
I think I really enjoyed, honestly, just meeting people and understanding different entrepreneur stories. One of the things that energized me most about working at Blue Haven was just the fact that I got to directly connect with all these people who had brilliant ideas and were able to execute on them. And I think that type of perspective is very rare. So that was something that brought me a lot of joy. In terms of things that I didn't enjoy, I mean, I don't think anyone really enjoys admin stuff and, taking care of all the logistics and setting up meetings. It's part of the job, but if there's anything that I had to point out, it would be that.
And because it seems like every industry is being impacted by AI, I mean, is that part of what you guys are looking into as well? Or are you guys, I mean, I know you guys are focused on tech. So are you guys more thinking maybe investing in firms that build in the capabilities more into the product versus like pure play AI companies, or is that not on the radar?
If it has a kind of societal benefit and a societal impact clearly built into the business model, then I think it's definitely something we'd look at. Something I feel like I've been fortunate to learn more about here at Wharton during the MBA has just been the implications of AI on our society and particularly in the investing world. And so I do foresee myself using a lot of those AI tools to hopefully boost my own productivity when I get back to work. But I also think from an investing lens, it's helped me kind of separate out the actual true investment opportunities from all of the noise. It's a bit like cryptocurrency in some ways, where there are a lot of companies that will advertise whatever the hot topic is at the time. And so, slap on AI enabled onto any investment deck and you're bound to get a few more eyes looking at your deck. And so part of, I think, the skill of VCs or any investors is to be able to actually determine who are those entrepreneurs that you want to invest in, who are actually developing AI capabilities or the infrastructure to support that. So to answer your question, yes, I do think we'll look at those opportunities, assuming that it still fits with our thesis.
And when it comes to advice that you could give, now that you've worked in both PE and VC, when you think about who is a good fit for either of these companies, what do you feel like makes for someone who would be a good fit for PE versus VC?
It goes back to, I think, your question around what makes a good investor in each of those realms. In PE, I think you have to be comfortable working with a lot of data. You have to be willing to kind of roll up your sleeves and just spend quite a bit of time staring at those numbers. And not only staring at those numbers, but making sense of those numbers and putting that into a form that other people can understand. A lot of PE is honestly storytelling and sales, where uh, you have to craft a story from all this data that you have in front of you and sell that to an investment committee, sell that to the companies that you're investing in.
Mm.
So as particularly at the junior levels, as someone looking to break in, the foundation is having those technical skills and being able to do that. But then the way you get ahead is by internalizing some of those sales and storytelling skills. At least that's what my view on it is. And then in VC, I think it's being very comfortable with ambiguity. You're going to be put in a lot of situations where, especially in the early stages, you don't know. You're just not going to be able to answer a lot of the questions that you have. And you have to be okay making a bet on things, making an informed bet on things, and taking a probabilistic approach to investing and saying, if I invest in, 15 companies here, chances are in the early stages, more than half of them are going to go to zero. And you have to be okay having enough conviction that the investments that you do really believe in and have done diligence on and place that bet behind, that they will succeed in the long run.
And were there any moments of the job in VC that, when you think about your time at Blue Haven so far, really, really excited you? I'm just trying to see if there are any like stories or moments that you reflect very like fondly on. I know you're going back, but if you could walk us through any, I don't know, like a moment or story where you felt like you were working and it was extremely fulfilling or exciting in some way.
The biggest thing is working in impact investing in that VC context. I've had the privilege to actually see firsthand the impact of the companies that we invest in. And I know that's kind of a secondary impact because I'm not the one that's necessarily building these businesses. But even just being on the ground in Nairobi, a couple of the companies that we invested in are what we call pay-as-you-go solar home system companies. And what that means is, a lot of sub-Saharan Africa is not electrified. They're off the grid. They live in rural communities. And for those households, electricity and sustainable electricity is a challenge. A bunch of entrepreneurs on the continent develop these solar home systems, which work from solar energy, kind of plug into your house and can power anything from your lights to your TV to your refrigerator. And the business model itself around that was, instead of having people buy it all up front, which is just way too big of a capital expenditure, you can do as a pay-as-you-go system. So for every month, you get charged kind of a rent on that solar home system that you purchase at much better rates than you would get anywhere else. And the businesses scale using that revenue. They're able to serve more customers, and the households that actually buy these now have access to electricity, which then has a knock-on effect because they can send kids to school. They can, have access to some of these other middle-class assets that they previously would not, because they have the very base electricity capability now. So being able to like visit those types of households and actually see these in huts, that was, I think, pretty powerful and put a lot more meaning around what I was doing.
Yeah, I feel like also being able to on the ground look at the companies you're investing in and the impact you're making really provide a lot of tangible experience and view of what you're actually doing. So I could definitely see that. And I also wanted to ask, you came to the MBA, even though you had all these experiences. Some people are recruiting for banking, PE, and VC amongst our classmates, and you're going back to Blue Haven. Like, what made you want to get an MBA?
For me, it came down to two things. One was building a really strong network. I felt like, regardless of the career that I chose to go into long term, having a strong community to me was proven out time and time again. When I worked in banking, when I worked in PE, when I worked in VC, the benefits of just developing really strong relationships with people, not only in a professional sense but also in a personal sense. I just know that has long-term benefits regardless of what you choose to do. So that was big, and a lot of the mentors I talked with, including the person that I work with who had gone to business school as well, everyone mentioned that in the long run, those people that you meet in business school will have pivotal impacts on your life. Again, not only in the professional realm, but also in the personal realm. So that was a big consideration for me. And then two was honestly being able to step back and absorb a lot of knowledge in 2 years and take the time to reflect on what I really wanted to build longer term. That was important to me. Coming out of banking, coming out of PE, coming out of VC, these are pretty intense roles where you're working almost around the clock and you don't have a ton of time to really step back and be able to do that reflection, I think, in a meaningful way. So for me, like having that time was really important. And I like to think that over the past 2 years, I've been able to do a bit more of that soul searching and at least narrow in on kind of the areas that I'd be interested in longer term.
Yeah. So in terms of that, what reflections have you made, and in the long term, whether it's personal or professional, what is like maybe one or two key things that you've reflected a lot on and realized?
I'll start with the professional side. On the professional side, I think, we talked a lot about AI earlier. Being in business school at a time when artificial intelligence is exploding on the scene has, I think, been a really unique opportunity because I've been able to be steeped in the research. I've taken multiple classes on AI. I've talked with professors who are experts in this field. And having that knowledge, I hope, will differentiate me as I kind of go back out there. And so understanding kind of where the interesting plays are within AI has a lot of value from a professional sense. Two, I think one of the reasons why I wanted to come to business school and build that network was I just knew that people that would be here have such unique insights into such a wide variety of fields. And just being able to talk with classmates about different things around, market trends, capital structures, these things that might be boring in everyday conversation, but when you're in a focused setting where people want to talk about that, has been really valuable and I think value additive as I think about my long-term career. And then finally, on the personal side, the last 2 years have taught me a lot about prioritization and also taught me a lot about the fact that life is really short. I've seen a lot of classmates go through a lot of tough things, loss of family members, loss of friends. And it's taught me a lot about when I think about my own career, there are certain things that just matter more than work. And so focusing on that and making sure that I structure my life in a way that prioritizes those things that matter to me most is really important.
I guess that's also a good kind of segue into you're going to be the commencement speaker in a matter of weeks. This actually may be published when the video, or when you have already spoken. So I'll leave a link to that. But can you give us a little bit of a preview of what do you plan to kind of talk about during your speech?
Yeah, I mean, without giving it all away, a lot of what I want to reflect on is what I just talked about, which is the power of community and the power of asking ourselves the tough questions around what we want to do and why we want to do it, and doing that in a way that is very deliberate and prioritizes those things that we each individually care about. And I think the overlaying theme is that when I think about the past 2 years, as we just talked about, the community that I've seen here is really powerful. And in a lot of ways, I learned much more about humanity than I did about business administration during this MBA experience. And so hopefully just bringing some of those themes to the class.
Awesome. Well, I think anyone watching this who wants more of Hari, then you feel free to check the link down below. Leave a link to that speech. And we've covered so much from banking and your background to PE and VC. And I think this will be helpful for so many people. So I just want to say thanks for making the time and sharing all the valuable insights and advice you provided throughout this conversation.
Of course. Thanks so much, Ben. Really appreciate it.
All right, so that concludes the episode. I hope you all enjoyed and learned a lot about private equity and venture capital. I thought Hari's insights and perspective was just very unique because not a lot of people have both experiences in these two buy-side industries. And as a friendly reminder, if you want to support this podcast or if you're interested in breaking into private equity, then be sure to check out the Wall Street Prep Wharton Private Equity Certificate Program. Use my code RARELIQUID to get $300 off. Also sign up for my banking course that's coming up. If you want to get 50% early, sign up using my link in the description as well. And last but not least, if you're interested in getting an MBA, check out our newly announced How to Get into MBA course at liquidmba.com and use my code SUMMER25 by August 30th, 2024 if you want to get 25% off. That said, thank you guys all so much for watching or listening in if you're listening on Spotify or wherever you get your podcasts. That said, thank you so much and see you at the next one. Peace.